situation where you have given credit, you will have costs that are you are incurring by administrating that credit. When I say administrating that credit, meaning that you have to send emails to follow up for the payments, you might have to make phone calls for follow up on the payment, you might have to at times go personally and meet the customer for it. At times there will be quality issues and such other issues that might have to be discussed, and those kind of issues, when they come up, the administration cost keeps going up, and therefore there is a certain amount of cost of administration attached to it. We also have something called interest cost, because the customer is still not paid while the goods have been delivered and is being used by the customer, and therefore you have in fact funded that customer, because you have already put the money into your goods by supplying it to the customer, and to the extent the money is locked up in those goods, you are incurring a interest cost. There could be legal cost, where a situation comes where you have made an assessment, the customer is not going to pay up, and therefore you have to proceed with the court procedures and legal procedures that are involved in making the recovery, and therefore there could be legal costs. So basically, irrecoverable debt means the business's expectation is that the net realizable value of that particular sale becomes zero. That means you are not going to get anything from that particular sale which you have now assessed to go bad or irrecoverable. So obviously, such amounts which you believe will not be recovered has to be treated as an expense in the profit and loss account. It will be a amount that will be expensed off, and therefore what we do, we credit we debit the irrecoverable debts or bad debts account, which is a P&L account, which is debited with the amount concerned, and the concerned debtor or the total debtors are reduced by that amount to which extent you believe the payment may not come, and thus this is expensed off in the profit and loss account as a loss, if you want to call it that. But it can happen that at a later date, through your efforts, this customer whom you have already written off is coming back and paying either fully or partly. Now in such a situation, obviously when the payment comes in, you will debit the cash or the bank account, and you will credit the irrecoverable debts or bad debts account. Thereby you will not do any entry into the debtors account, because you have already reduced the debtor and said that that amount is going to be not recovered. Any recovery is then taken as a directly into the profit and loss account. So at the end of the year, you will debit irrecoverable debts account or bad debts account and credit the P&L account, thereby recognizing that on a written off debt, on a written off debtor amount, whatever you are recovering is a profit straight away, because initially itself you would have expensed it off, and if the recovery does come after a few days or a few years, it is taken it as a income in that year, which is an unexpected income in that particular year. The debtors account is not touched, because initially the debtor has already been reduced. Now we move on to see the next concept, which is allowances for debtor, or also what is called as provisioning for bad debts. In any business situation, we know when credit sales happen, not all the amount that you sell, or the sales value is not the amount that you actually realize finally in terms of cash. That is, in other words, to say that the net realizable value of your debtors or of your sales is not equal to the sales value. Now that is the concept that goes into making out for allowances for debtor. You know that by practice that for every 100 rupees of sales, either 3% or 2% or 5% of your customers value doesn't get paid up. Now that can be an industry experience, that can be the experience of the business. So it is prudent, in which case the concept of prudency or concept of what we otherwise known as conservatism tells us that we should not recognize the sales at full value, the debtors at full value, but less the experience allowance we want to give. We are saying okay, I have sold 100, 3% may not come or 5% may not come. Now such a concept is, when used, is called as providing an allowance or doing a provision for such possible defaults by your customers, which basically uses the prudent or the conservatism principle in accounting, and it assumes, as I said before, that NRV of the debtors will be less than the actual sales value. Now, the entries that we will pass when we actually create the provision or the allowance would be to debit the profit and loss account, treat it as an expense, and credit allowances for debtor or provision for bad and doubtful debts. And whenever we decrease the provision, we will debit allowances for debtor and credit the profit and loss account. Let us look at an example to make these entries much more clearer. So, we have a situation, a firm which makes a provision at 10% of the outstanding debtors at the end of the year. So, end of 31st March, it had 50,000 rupees towards debtors, and it makes a 10% allowance, saying that that is a provision for bad and doubtful debt that it is going to make. Similarly, on 31st March 2011, the debtors figure was 60,000 and the same 10% provision was to be made. And at the end of March 2012, the debtors outstanding was 40,000 and the same 10% provision or allowance was to be made. So, now keeping these figures in mind, let us see what the entries that would have been passed. Now, the first entry is when they actually make the first provision of 10% on 50,000, which is 5,000. So, you will debit profit and loss account, credit the allowance for debtors with 5,000 rupees in the first year. After that, the next year we have said the allowance has to be, or the provision has to be 10% of 60,000 outstanding. So, my allowance figure has to be 6,000. Already I have brought forward 5,000 which you have provided last year. So, that is 5,000. So, my additional requirement of provision this year is only 1,000 rupees. So, I will use, by debiting P&L and crediting the allowances for debtor account, I will only do it for 1,000 rupees, making sure that the allowance is 6,000 rupees now. Now, this 6,000 rupees again is brought forward here, and next year the allowance required is 10% of 40,000, which is 4,000 rupees. Since the amount already brought in is 6,000, what we need is only reduce this allowance by 2,000, and therefore we will credit the profit and loss account this time by 2,000 rupees, and also thereby and debiting allowances for debtors for that amount. So, whenever increases were there, we debited the profit and loss account and credited allowances for debtor. Whenever the decrease in allowance was there, we credited the profit and loss account and debited the allowance for debtor. This is the way provisioning is done. Now, how does it reflect on the P&L extract or P&L account? If you see, for 2010, the gross profit, we have to reduce this increase in allowances for debtor or provision for bad and doubtful debts from the gross profit to the extent of 5,000. This was the first provision that was made. In next year, our provision requirement was 6,000, 5,000 was already there. So, additionally in the profit and loss account, I had to make only 1,000 rupees additional expense that we will incur, making it 6,000. So, in 2011, the additional P&L debit was only 1,000. But when we moved out at the end of 2012, we required only 4,000 as the provision, but we already had 6,000 provided, and therefore we had to credit, that is, add it as an income in the P&L of 2,000 rupees, effectively providing for 4,000 rupees as provision for bad and doubtful debts or allowances for debtor. In the balance sheet, of course, each year the debtor will reflect as the amount due from debtors less the allowances or the provision for bad and doubtful debts. 5,000 in 2010, 2011 6,000, 2012 4,000, which we saw in the entries, thereby giving us a net realizable value, estimated net realizable value based on our experience of 45,000, 54,000 and 36,000 respectively. Overall, this is how we look at the irrecovery or the bad debts treatment, as well as a prudent, most firms actually as a prudent principle use the provisioning or the allowances method, thereby providing for debtors not paying in this way. It can also happen that you have specific customers whom now you feel may not pay, or for which provisioning is required in this nature. That also can be done based on the business's assessment of the situation. So that is how we look at the debtor, the allowances for debtor, as well as the treatment of bad debts or irrecoverable debts.